Welcome back to the deep dive. When most people think about investing in healthcare, their mind usually goes to uh, pharmaceuticals or maybe biotech.
Yeah, the flashy stuff, the next big drug.
Exactly. But today, we're diving into the true infrastructure of U.S. healthcare. We're talking about the managed care companies.
The massive insurers, the ones managing the risk, the payments, and, well, increasingly the care itself.
And our mission today is pretty straightforward, but it's powerful.
We're not looking for the next high-growth stock. We are applying the gold standard of conservative investing. We're using Warren Buffett's value principles,
We want to find the best business, the one built for durable long-term success.
not just the stock that's hot today.
Right, so we're using the full checklist. First, does the company have a wide competitive advantage, what Buffett would call a durable moat?
Is its financial condition absolutely rock solid? Are the earnings consistent, high quality?
And is the management team capable,
Yeah.
strategically sound?
And crucially, the bottom line, is there a margin of safety? Are you getting a fair price for all of that quality?
Our deep dive today focuses on three major players.
We've got UnitedHealth Group, UNH, the undisputed market leader. Then there's Molina Healthcare, or MOH, which is a specialist in government plans.
And finally, Elevance Health, ELV, which a lot of you will probably still know by its old name, Anthem.
And the goal is to find the most balanced choice for you, the conservative, long-term investor.
Okay, let's jump right in with the most important metric for Buffett, the moat. In healthcare insurance, it's not like they're selling a patented product.
Yeah.
So what really protects these giants?
It really boils down to a few key things. Extreme scale is the first one.
Okay.
Then you have the immense regulatory barriers to entry. And finally, established brand franchises. You can't just start a competing insurance network tomorrow.
You need billions in capital.
Yeah. Billions. And years of negotiations just to build a network that could even compete. Their sheer size gives them enormous leverage over hospitals, over drug companies. It lets them drive down prices.
And if we're talking about scale and moat, we have to start with UnitedHealth Group, UNH. It's really more than just an
Well,
insurer.
absolutely. It's an ecosystem. UNH has built the widest moat in the entire sector by moving way beyond that traditional insurance model.
They created a fully integrated system.
That's it. So you have United Healthcare, that's the core insurance arm. But the engine, the thing that's really driving their competitive advantage, is Optum.
Their health services division.
Right. It's their pharmacy benefit manager, their
Yeah.
PBM, it's their care delivery networks, their analytics. It's everything.
So that integration is the real secret sauce. Optum isn't just about diversification. It's about them controlling the underlying cost structure internally.
You've nailed it. If they can control the cost of drugs, of doctor visits, of administration, they can manage their medical cost ratio, their MCR, better than anyone else.
And that's the key insight you really need to carry through this entire deep dive.
It is. The medical cost ratio, for those who don't know, is just how much of every premium dollar they collect goes out the door to pay claims.
So if you keep that ratio low,
Your profit margins expand.
Yeah.
UNH's scale, combined with Optum, gives them the best shot at doing that consistently. It's why they're ranked the most valuable healthcare brand for 9 years running.
and why they have that crazy consistent revenue growth of over 9% a year.
Exactly.
Okay, so next up, let's look at Elevance Health, ELV. Their moat is also very powerful, but it's built on a different kind of asset.
It is. It's a franchise model. ELV holds the exclusive license to the Blue Cross Blue Shield brand in 14 large states.
And that brand recognition, that loyalty is, well, it's priceless.
It gives them a really durable edge, especially in the commercial insurance markets. They're the second largest insurer in the country, serving over 45 million members.
And just like UNH, they've realized they can't just be a claims processor anymore.
Right. They're strategically building out their own integrated services now. You have Carelon EOS and Carelon Services.
And they're designed specifically to mirror Optum, right? To get that same control over the MCR.
That's the playbook. They see that integrating physical, behavioral, and social health is the future. They're playing catch-up to UNH for sure, but they have the foundation, that Blue Cross brand, and the commitment.
So where does that leave our third company, Molina Healthcare, MOH? Their story is, well, it's one of specialization.
It is, and because of that, their moat is distinctly narrower. MOH focuses almost entirely on government-sponsored plans.
So Medicaid, Medicare Advantage, the ACA marketplaces.
Yep. Their whole differentiator is being super cost efficient and serving those low-income populations, but they pay a massive price for that lack of diversification.
But hold on. By focusing only on Medicaid, doesn't that mean MOH avoids all the complexity and cost volatility of the commercial market? Isn't that a strength in its niche?
It's a strength until state funding falls behind medical cost inflation, which is a constant risk.
I see.
The source material showed something like 79% of their premium revenue comes directly from Medicaid. So when the MCR spikes, and we know it does, MOH is just completely exposed.
They don't have an Optum or a Carelon to smooth out those bumps.
They have much less margin for error.
That concentration is a real concern for a conservative investor. Let's pivot now from the moat to the hard numbers, the financial fundamentals. This is where we see if the price matches the quality.
First, let's just re-anchor on the scale difference here. UNH is the giant, approaching a $300 billion market cap.
Wow.
ELV is large, around $72 billion, and MOH is much, much smaller. It's closer to a mid-cap company at about $7 billion.
Okay, now for the valuation ratios, the price tag. We're looking at PE and PB.
Right. Price to earnings tells you how much you're paying for a dollar of profit, and price to book, how much you're paying over the company's net asset value.
So where does Molina fit in?
MOH is, without a doubt, the cheapest. Its trailing PE is about 9.4, and its PB is 1.7. For this industry, those are low numbers.
And that signals the market either sees higher risk or expects less growth.
Precisely.
And ELV is more moderately valued.
Yes, ELV trades at a PE around 10.6 and a PB of about 1.67. That suggests the market values the company very close to its underlying book value, which is pretty attractive.
And then there's UNH, which, as you'd expect for a quality leader, trades at a serious premium.
That's right. UNH's PE is up around 15, and its PB ratio is significantly higher at 3.22. You're paying top dollar for that wide moat, the consistent earnings, and of course, the Optum diversification.
Okay, let's touch on balance sheet health, specifically liquidity. We should probably address the unique nature of insurance balance sheets.
It's a bit counterintuitive because insurers operate on what's called premium float. They get cash upfront for claims they'll pay in the future. They often have a current ratio below 1.
So it's okay for UNH to have a current ratio of 0.83, when normally we'd want to see that at 1 or higher.
For them, yes, because that float effectively covers their short-term obligations. However, it is interesting that MOH at 1.68 and ELV at 1.56 have ratios well above 1.5.
Which suggests they have a healthier immediate cash cushion.
A bigger buffer, yeah. Which can be very useful when medical costs suddenly spike.
And what about leverage? Debt to equity.
MOH carries the highest relative leverage at around 0.92. UNH and ELV are more moderate, both sitting around 0.7. Again, the smaller, more specialized player is carrying more financial strain.
This is where the contrast gets really stark, though. Cash flow quality. UNH is just the picture of consistency.
Unmatched consistency. In 2024 alone, they generated $24.2 billion in operating cash flow. That's an outstanding 1.6 times their reported net income.
And that strong cash flow is the hallmark of high-quality earnings.
It is. It lets them pay a substantial, reliable dividend to shareholders.
Now, MOH, on the other hand, they had the fastest recent revenue growth, 19% in 2024, but there's a huge, flashing red warning sign here.
There is, and this is critical for you to see. Operating cash flow for MOH collapsed in 2024. It fell from $1.6 billion in 2023 down to just $644 million.
Wow. That is a drastic loss of cash.
It's alarming for a company that's already highly leveraged and exposed to MCR risk, especially since they don't pay a dividend.
And ELV is sort of comfortably in the middle. Moderate growth, decent margins, and reliable cash flow that supports a modest dividend.
Right. So if you connect this to the bigger picture, UNH and ELV have the financial flexibility a conservative investor demands. MOH's cash flow collapse. It raises really serious red flags.
Let's pivot hard now to the qualitative factors. Management quality, strategic risks, and insider confidence. Who's steering the ship matters immensely here.
And we can gauge what they're really thinking by looking at insider trading.
Let's start with the one facing the most acute pain, MOH. The financial risks we just talked about. Well, they turned into a catastrophe in the third quarter of 2025.
A total catastrophe. Their net income collapsed. It fell from $326 million down to just $79 million.
And management blamed unprecedented medical cost escalation. What exactly was that?
It was mainly two things. A huge spike in utilization in their Medicare Advantage plans, plus the ongoing Medicaid redeterminations.
So people who had deferred care during the pandemic were finally going back to the doctor.
Exactly. And because MOH is so concentrated in those government plans, they felt that spike immediately and very severely.
That staggering earnings crash led to them slashing their full-year guidance by 26%.
And that triggered a negative signal from the credit market. S&P Global revised MOH's credit outlook to negative in November 2025.
Now add the insider trading on top of this.
This is the real kicker. The CEO, Joseph Subretsky, sold $28 million of his shares in April 2025. Overall, you saw $28.6 million in sells versus only $1.5 million in buys in the last year.
When the leadership is running for the exit like that.
It's a triple whammy of warning signs. Buffett himself would run the other way.
Okay, now compare that to UNH. The market leader had a leadership change when CEO Andrew Whitty stepped down mid-2025. A former CEO, Stephen Hemsley, returned. That kind of volatility at the top must have been scary for investors.
You'd think so, but they handled it by showing extreme internal confidence. While Whitty's departure was a surprise, the insider activity shows the complete opposite of a company that's rattled.
What happened?
Hemsley and the CFO, John Rex, together bought over $30 million in shares in May 2025.
$30 million in buying. That is a huge signal.
It's management signaling a strong belief that the company's long-term prospects, especially Optum's strength, are totally uncompromised.
A powerful counterbalance to that surface-level volatility.
Absolutely, and analysts agree they're maintaining a buy consensus with about a 32% upside.
Finally, Elevance Health. Their leadership seems far more stable, which is a big plus.
It is. The CEO, Gail Boudreaux, who actually came from UnitedHealth Group, is very highly regarded. She's been transforming ELV for years, driving that Carillon initiative.
And what's the insider story there?
So there's been modest net selling overall, but Boudreaux herself personally bought $2.4 million of shares in July 2025. She put her own money behind her strategy.
That's real confidence. What's the main strategic risk they're facing right now?
The risk is centered on their Medicaid portfolio, just like with MOH. But ELV is handling it proactively. Management is forecasting that their Medicaid margins might temporarily go negative in 2026.
Wow, that's some honest transparency.
It is. They're bracing for the same cost inflation that just crushed MOH, but they have a clear plan for recovery.
What's the plan?
Cost management initiatives and further expansion of Carillon services. They expect to recover back to a 2 to 4% margin by 2026.
That combination of stable leadership, transparency, and a clear path forward, that provides confidence.
It's exactly what a conservative investor needs to see.
Okay, so we have a clear hierarchy here. Let's synthesize all of this against our Buffett checklist moat: quality and price.
UNH is without question the highest quality business. Widest moat, strongest cash flow, extremely confident management.
But its high PB ratio of 3.22 means you're paying a big premium. There's not much of a margin of safety on the price.
Exactly. And MOH is the cheapest on paper, low PE, low PB. But that cheap price comes with enormous acute business risk.
The earnings crash, the negative credit outlook, the heavy insider selling. It just obliterates any margin of safety.
That stock is cheap for a reason, which leaves Elevance Health, ELV, standing out as the most balanced value play for the long-term investor.
So walk us through it. Why is ELV the overall winner for the conservative investor in this deep dive?
Because it really hits the sweet spot on our checklist. First, it has a durable moat through the Blue Cross Blue Shield brand and its growing scale. Second, it offers a moderate, attractive valuation. That PE around 10.6 and PB around 1.67, that provides the margin of safety you need.
Okay.
And third, it has stable, proven leadership with a clear strategic path for navigating that predicted dip in Medicaid margins with a clear recovery path by 2027.
So it's giving you quality, moat, and price all at the same time.
It is. You get the competitive advantages of a major insurer without the premium price tag of UNH.
And crucially, without the acute earnings volatility and massive insider caution we see at MOH.
For a conservative investor who's looking for durable returns in the healthcare space, ELV's balance of competitive strength and moderate valuation makes it the preferred value-driven choice.
That brings us to our final thought for you to chew on. We mentioned the medical cost ratio, the MCR, early on, and it's the metric that's going to define the future of this whole sector.
The battle really isn't about collecting premiums anymore. It's about controlling costs. These MCRs are already high across the board. UNH was at 89.4%, ELV at 88.9%, and MOH hit 90.4%.
So they're all paying out close to 90 cents of every dollar they take in.
Right. And as those costs keep rising, the critical long-term question for your shareholder returns is this: how much true, sustained competitive advantage will integrated arms like Optum and Carelon ultimately provide?
Can they actually manage those costs down and generate real profit outside the traditional insurance model?
That's it. That operational efficiency is where the real future value of these companies is going to be created or destroyed.